Hello class, this is Econ 510 Managerial Economics class. Today is April 19th, Tuesday. Today is the last day of the class.
Today is the last day of the semester class. So here is the order of video clips we are going to discover today. Number 1, adverse selection. 2, adverse selection for sellers. 3, insurance and hazard, moral hazard. 4, asymmetric information. Here is the first video clip.
Now we're going to look at markets where there's asymmetric information. These become very fascinating markets because it gets some outcomes that are really interesting and applicable in a lot of markets. Asymmetric information is a situation in which one side of the market, either buyers or sellers, knows more information than the other. This is different than a perfectly competitive market where buyers and sellers have full information about the quality of goods and the prices and whatnot. And here we're going to look at what happens when one side of the market knows more than the other side. And we may get a mixed market. It's a market in which goods of different qualities are sold for the same price. Now let's look at what happens in a mixed market. Suppose we're talking about two different types of goods, a plum and a lemon, where plums are good and lemons are bad. What happens then? Well, we need to understand a little bit about our buyers. Right, so suppose the price that maybe we're talking about a used car. And if you got a good used car, you'd be willing to pay more if you knew it was a good used car. You'd be willing to pay less if you knew it was a bad used car. So suppose we said that the price that consumers are willing to pay for a plum was equal to $4,000, and the price that consumers are willing to pay for a lemon is only $2,000. That's what it's worth to the buyers. Now, given that information, let's try to figure out what's going to happen in this market. Now, you're a car buyer, so you're a demander, and you actually don't know how good a car is when you go look at it, when you want to buy it. You know it's a plum or a lemon, but you really don't know for sure which one it is. You know you're willing to pay $4,000 for a plum and $2,000 for a lemon. Now, suppose you thought there was a 50-50 chance between getting a lemon and a plum. If that's the case, if you had a 50% chance of getting a plum and a 50% chance of getting a lemon, you'd be willing to pay $3,000. That's what this green line here represents. It's the willingness to pay with 50-50 expectations. Now, what do we see in the market? Well, here's the supply curve for lemons, or low-quality cars. Here's the supply curve for plums, or high-quality cars. Plums are high, the supply curve is higher up because they're worth more, and so suppliers are going to require a higher price for a plum than for a lemon. Now, the difficulty is we don't know what plums and lemons are. We can't tell by looking at the car necessarily whether it's a plum or a lemon. So the seller has to charge just one price. Now, if the price were $3,000, that's the willingness to pay, we would expect to see 20 plums sold per day and 80 lemons sold per day. Now, the problem is this isn't an equilibrium because the buyers had a 50-50 expectation and the outcome was only 20% plums and 80% lemons. Buyers would adjust their expectations, and the price that they'd be willing to pay would go down because they were getting a higher percentage of lemons than they expected at that price. So as the price falls, we see the supply of both goes down, but suppose it went down to $2,000. Is this an equilibrium? Well, at $2,000, we're expecting, these are pessimistic expectations, we're expecting all the cars to be lemons. And that's we're willing to pay $2,000 as buyers. What do we see? Well, at $2,000, 0 plums are supplied, but 45 lemons are supplied. So we expect 100% lemons. We're getting 100% lemons. So this is an equilibrium. The problem, again, is that we don't have symmetric information. Sellers know whether they have a good car, and thus would require a higher price than if they had a lemon, a bad car. But buyers can't tell, so they're only willing to pay one price. The presence of the bad cars drives the good cars out of the market. This is called adverse selection. It's a situation in which the uninformed side of the market must choose from an undesirable or adverse selection of goods, not able to get plums because the lemons drive them out of the market. The presence of the low-quality goods in the market pulls down the price consumers are willing to pay. The decrease in the price decreases the number of the high-quality goods supplied, decreasing the average quality of the goods, which further decreases the price that consumers are willing to pay. Is it possible that we could get what's called a thin market where some plums are being supplied? It is. It all depends on where the supply curves are. Suppose our supply curve for plums was here, and our supply curve for lemons was here, and we had a pessimistic expectation. We thought all the cars being supplied were going to be lemons, and thus our willingness to pay would be $2,000. Well, given this supply curve, we would see that there's a few plums being supplied. So this isn't an equilibrium, because we were expecting 0% plums, and we actually got 10% plums. So given that, our price would rise, our willingness to pay would rise, because we know that there's some chance we're getting a plum. And the equilibrium is going to be at this position where the proportion of plums is equal to the expected level of plums driving this price, $2,500. So adverse selection is a problem in an asymmetric market where buyers don't have good information about the quality of the product. Now we know that there's an adverse selection problem called the lemons problem when we look at an asymmetric information market where buyers don't have as good information about the quality of the product as sellers do. The problem is we see lemons, the bad products, driving plums, the good products, out of the market. And the classic example is for used cars. Now, what do we do about this? How do we solve this problem? Because buyers want to buy good cars, sellers want to sell good cars, but they won't be able to do it if they can't differentiate between good and bad cars. Well, one of the solutions is buyers invest in information. They look at consumer reports. For cars, they look at Carfax, which gets information about individual cars and their accident histories, and get some idea of whether it's a good car or a bad car. We also see customer satisfaction scores from ValueStar and eBay so that buyers have some idea whether they're buying from a good seller or not. And sellers give guarantees, and there are lemons laws, so we get a money-back guarantee and warranties and repair guarantees. So if you're a seller and you're trying to show that you're selling a good product, you would have a money-back guarantee or a warranty so that buyers could look at it and say, well, I'm going to increase my expectations about whether I'm getting a plum over getting a lemon. So these are different ways that we've seen consumers and sellers try to overcome the adverse selection problem and the lemons market. We've already talked about the adverse selection problem when the buyers have imperfect information, but we can also look at a market where the sellers have imperfect information. A good example of this is insurance. Suppose you have a mix of consumers. Some of them are high-cost consumers and some of them are low-cost consumers when we're talking about insurance. So if you were the insurance company, you would charge the high-cost consumers $6,000. And suppose you would charge the low-cost consumers $2,000. But when a consumer comes or a customer comes to you and says, I would like to get insurance, you don't know whether they're going to be a high-cost customer or a low-cost customer. And so you have to make some guess on what price to charge. If you had 50-50 expectations between whether it was a high-cost or a low-cost, you might charge $4,000. Now let's look at the adverse selection problem in this market. If your price is $4,000, well, the demand for insurance for low-cost individuals is going to be lower than the demand for insurance from high-cost individuals. People who know they're high-cost individuals are more likely to get sick, more likely to get in accidents. They know this, they're more likely to want insurance than a low-cost individual would. So the demand for high-cost people for insurance is higher than the demand for low-cost individuals. So if you're expecting a 50-50 split between high and low-cost consumers, you're going to get a disequilibrium in this adverse selection model where we have asymmetric information. Why is that? Well, at $4,000, we can see the number of insurance customers that are low cost is going to be 25, and the number of insurance customers that are high cost is going to be 75. So you set your price based on a 50-50 split, and given that price, you got a 75% high cost and a 25% low cost. Doesn't meet your expectations. You got a higher percentage of high cost customers than you expected, and thus the insurance company raises its price. It can get up to a price where the expected cost is based on pessimistic expectations that all consumers are going to be high cost consumers. That price is going to be $6,000, and at that price you're getting 40 customers that are high cost and 0 customers that are low cost, and your expectations are met. So this is going to be an equilibrium. But what we see is the high cost demand from high cost people drives out low cost people. So we see low cost insurance consumers don't consume any insurance, and we only have high cost individuals getting insurance. That's the adverse selection problem for sellers, and we see that often in insurance markets. Another issue that comes up in asymmetric information markets is moral hazard. Moral hazard is a situation in which one side of a market or one side of an economic relationship takes undesirable or costly actions that the other side of the relationship cannot observe. We're going to talk about some examples to make this a little more illustrative. And so suppose we're looking at an insurance market, and you're an insurance company and you give me insurance. I buy insurance for you for my home. Well, I might be more reckless with my home. I might have more fires in the fireplace. I might jump off the roof because I know I have home insurance. That seems a little preposterous, but we can look at car insurance. Car insurance companies want people to drive safely, but somebody who has car insurance or automobile insurance might drive more recklessly because they know they have insurance. That's the moral hazard problem. Individuals might do behaviors because they have insurance that makes insurance more necessary. And so insurance and moral hazard go hand in hand with each other. People who have health insurance might eat more unhealthily because they know they don't have to pay for going to the doctor. So what do insurance companies do about it? Well, to try to take care of the moral hazard problem, they have a deductible, which is a dollar amount that a policyholder must pay before getting compensation from the insurance company. That means that individuals have to at least think about their costs somewhat because of the deductible. But moral hazard is a very interesting phenomenon in markets because people might behave differently because they've purchased insurance. We saw this perhaps in the savings and loan crisis of the 1980s, that financial institutions did more risky loans because the deposits that they had were insured.
Why is it so difficult to buy a good used car? Have you wondered about that? This is a great example of a problem economists call asymmetric information. Asymmetric information means that one party in a transaction has more information or knowledge about the quality of the good being traded than the other party does. And asymmetric information can really mess up a market. In a previous lecture, we talked about risk. Risk is when an agent looks at the odds and takes a gamble. You decide whether to buy insurance on your house or not. You decide whether to play roulette or not. You decide whether to buy a lottery ticket or not. You decide ahead of time whether you want to subject yourself to the odds, whether you think your chance of winning is enough to warrant the cost that you are incurring to take the gamble. Asymmetric information is a different kind of problem. This is a problem that stems from the distribution of information, what different people know, the fact that one person knows more about a trade than the other. And one of the things that we learn when we study information is that sometimes a little bit of information can make the situation much worse than no one having information at all. Let's look at this example as we consider what economists call the problem of lemons, the market for lemons. Now, a little bit of vocabulary here. For any of you who are non-native speakers of English, a lemon refers to a car that is so much trouble that it isn't worth it. You have to spend so much time and money repairing it that you don't get enough value to warrant the expense. We will contrast a lemon with a gem. A gem is a good car that you buy that gives you a lot of satisfaction and very small repair bills. Now, let's suppose that we have a situation where there is complete knowledge about the quality of cars. This would be a market in which there is perfect information. We'll consider first the case of perfect information. And let's suppose that in this market, the price that a buyer is willing to pay for a gem is equal to $10,000. So the price a buyer is willing to pay for a gem is $10,000. And let's suppose also that the price that a seller will accept for a gem, the reservation price of sellers, is equal to $8,000. Now, in this case, you can see very clearly that it's great for buyers and sellers to get together. That is, buyers are willing to pay a price that's higher than the price sellers are willing to accept. That there is $2,000 worth of economic value created by getting the buyer and the seller together. So, if there's a gem, the trade should certainly take place. On the other hand, let's suppose that with lemons, there is no value for a lemon to anybody. Buyers wouldn't pay any money to get one, and sellers would be willing to give the lemon away for free. So we've got gems and lemons, and we've got the reservation price that buyers have and sellers have for each of these two kinds of cars. Now, if we have perfect information, our first case, what's going to happen? If buyers and sellers all know whether any given car is a gem or a lemon, what is going to happen in that case? The answer is the sellers will sell the car to the buyer at a price somewhere between $8,000 and $10,000. What do economists think about this outcome? They think it's great, right? Because the car goes from the hands of the seller, who values it less, to the hands of the buyer, who values it more. Great. With perfect information, no problem. Trades take place and economic value is created. What about the lemons? Well, if you're sure that a car is a lemon, then you're not going to pay anything for it, but the seller would just as soon give it to you for free, and the economist doesn't care anyway, because lemons aren't creating any economic value for anybody. So no matter who gets the lemons, it's just a wash. Let's consider now a second case. In this second case, let's suppose we have uncertainty on both sides. That any given car could be a gem or a lemon, but the buyer doesn't know which is which, and the seller doesn't know which is which. You could think of this as the market for new cars that roll off the factory line, and the seller doesn't know whether it's a gem or a lemon, and neither does the buyer. There's the same uncertainty on both sides of the story. Let's suppose, however, that there is one other piece of information that both the buyers and the sellers have. And that is that 50% of the cars that roll off the factory line are gems, and 50% are lemons. Now, given that you're buying a car and you don't know whether it's a gem or a lemon, but you do know the odds, the market for cars becomes a kind of lottery. When you buy a car, you're buying a lottery ticket. You're buying something that half the time is going to be worth $10,000 to you if you're a buyer, and half the time it's going to be worth nothing to you because it's a lemon. On the other hand, if you're selling these, you're also selling lottery tickets. 50% of the time, you're selling something that's worth $8,000 to a seller, and 50% of the time, you're selling something that's worthless. So, let's suppose, for the sake of this story, that all of our agents are risk neutral. That is, they they are equally excited about gains as they are concerned about losses. That is, the value of any gamble to a risk-neutral person is the expected payoff from the gamble, the expected value. Well, in that case, for the buyers, the expected value of a car is 50% or 1/2 times 10,000. That's the chance of getting a good car, plus 50% times 0, the chance of getting a lemon, multiplied by the value of a lemon, and that equals $5,000. $5,000 is the expected value when you buy this new car, and that's what a buyer would pay if the buyer is risk neutral. Now, how much would a seller want to sell the car for? Remember, 50% of the time it will be a gem, 50% of the time it will be a lemon. You calculate. What's the value at which a seller would sell a car under this situation of uncertainty? In this lesson, we'll introduce how economists describe people's behavior under uncertainty, or the way people make choices in the face of risk. Let's suppose I offer you a gamble. I'm going to flip this coin, and if it comes up heads, I'll pay you $2. If it comes up tails, on the other hand, I'll pay you nothing. How much would you be willing to pay to play this game with me? Well, let's figure out, first of all, what the expected value of this gamble is. The expected value is the average return if you play the game over and over and over again. The expected value is calculated as follows. First of all, take the odds of each outcome and multiply those odds by the value of that outcome. So for instance, the odds of the coin coming up heads are 50%, or 1/2. The value in that case would be $2, the amount of money that I would pay you. The odds of the coins coming up tails are also 1/2, and your payment in that case would be 0. You get nothing according to the rules of this game. So if you multiply the odds 1/2 times the outcome $2 and add that to the odds 1/2 multiplied by $0, you get the expected value of this gamble, which in this case is equal to $1. Think of this $1 this way. If you played this game with me over and over and over and over again, your average payoff would approach $1. Now, that's the expected value of the gamble. How much would you be willing to pay me to play this game? Well, some of you might be willing to pay $1 to play the game. In that case, you are what we call risk neutral. A risk-neutral agent values a gamble at its expected value. You're the people who would pay me $1 to play the coin toss game. Some of you might be willing to pay me even more than $1, maybe $1.05 or $1.25 to play this game. If your willingness to pay is greater than the expected value, we say that you are risk-inclined or risk-loving. These are people who are willing to pay more than the expected value to take a risk. These are people who are excited about the prospect of winning and value that more than the possibility of the loss. Now, many of you out there would not be willing to pay me $1. Your maximum willingness to pay for this gamble may be only 75 cents, or 50 cents, or 25 cents. This is what we call risk aversion. People who are not willing to pay the expected value of a gamble are described as risk-averse. For a risk-averse agent, the risk of losing is valued more heavily than the possibility of winning, and therefore the value of the gamble to that person is less than the average return, less than the expected value. Now, it's kind of interesting why it is that people will buy insurance and also go to Las Vegas and gamble on a vacation. Sometimes we act as though we are risk-averse. Whenever you buy insurance on your house, you're paying someone to take the risk away from you. And usually what you're paying is greater than the expected value of your loss. There's a very small probability that your house will actually burn down. But if you multiply that probability by the value of your loss, in the case of a fire, you'll get the expected value of the loss to you. The fact that you're willing to pay more than that you're willing to give up more money than you expect to lose in order to be protected from the risk, is an indication of your risk aversion. On the other hand, if you buy a lottery ticket or go and gamble in Las Vegas, you are paying more to play that game than you are expecting to win. That's because your focus on the possibility of a big return is enticing you into the game. You're behaving as a risk lover. If there is a 1,000,000 to 1 chance of winning the lottery, and the return on winning is $1 million, then the expected value of a lottery ticket is $1. If you're willing to pay $2 for a lottery ticket, it's because the jackpot excites you, and the risk of losing your $2 is not as important to you. You're behaving as a risk lover. So sometimes we'll behave as a risk lover in one aspect of our lives, but as risk averse in other aspects. Most of us are risk averse when it comes to the possibility of losing our income, or losing our house, or losing something else that is of great value. On the other hand, we're likely to gamble with small amounts because we enjoy the prospect of winning a big jackpot. So the way economists describe risk attitude is with 3 concepts. People who are excited about risk would be called risk lovers, or people who are risk inclined. These are people who are willing to pay more than the expected value in order to take a gamble. People who are neutral about risk, who value a gamble at its expected value, are called risk neutral. And finally, most of us, with at least large amounts of value, are risk averse. We would be willing to pay more than the expected value of a loss to be protected from the loss, and less than the expected value of a gain in order to have the chance of winning. We're the people who value the coin toss game at 50 cents or 75 cents, but never at $1.25. This is the notion, then, of how economists think about risk behavior. This idea of risk behavior is the basis for theories about how stocks are priced based on their expected value, how insurance is priced, and people's willingness to pay to avoid risk becomes the price of insurance. Also, it has to do with how much extra you would have to pay one of your employees if you put her on a sales commission. Once her income is uncertain, she'll need some kind of compensation to make her willing to take that risk. So the theory of risk behavior is used frequently in economics to describe financial markets, to describe sales plans, to describe insurance markets. It's a useful concept. So for a quick review, to calculate the expected value of a gamble, take the probability of each outcome and multiply it by the value of that outcome. Add them up and you get the expected value. Now, to consider how much an agent is willing to pay to take that gamble, you need to know about the agent's risk attitude. If the agent is risk inclined, he'll pay more than the expected value. If the agent is risk neutral, he'll pay exactly the expected value. And if the agent is risk averse, he's willing to pay some number that's less than the expected value. In the previous lesson, we introduced the concept of asymmetric information. Asymmetric information exists when one party to a deal knows more about the quality of the good being traded than the other party does. And we looked last time at a particular kind of asymmetric information, when one party knows about the trait, some unobservable trait of the good, or some unobservable trait of themselves. I'm a seller and I have a car for sale. I know whether it's a gem or a lemon, and you, the buyer, don't. I'm applying for health insurance, and I know what my health risks are, and you don't. You're the seller of insurance. Or I'm a student who wants to join a study group. Perhaps I know more about my aptitudes and skills than you do, my other people in the study group that I'm trying to get to invite me. Whenever one party has special knowledge about some kind of characteristic, then we get the problem of adverse selection. The presence of low quality drives high quality out of the market. The presence of lemons causes people who have good cars to take them out of the used car market. The presence of people with high health risks in the market for insurance drives up the price of insurance and causes people with low risks to drop out of the market. The presence of people who are not especially hardworking students or devoted to serving their study group causes people to be very careful about who they invite to their study group. And once people get into the study group that aren't hardworking and aren't contributing, then it's always the smartest students who seem to leave first because they could do better on their own. This is the problem of adverse selection. Now, there's another problem that stems from asymmetric information, and that's called the problem of moral hazard. Moral hazard arises when one of the parties to the deal takes an unobservable action after the deal is done. This is the example of someone who gets insurance and then decides to behave in a risky fashion. For instance, when I went to apply for insurance on my house, I was very happy not to have to worry about things being stolen from my house, and therefore I was more inclined to leave the windows open when I went out for a walk, or maybe even leave the back door unlocked whenever I went to work. After all, carrying around keys is a bit of effort, and I like the windows open during the day because the house then smells fresh when the breeze blows through. However, whenever I take that choice, when I make that decision, I'm imposing a cost on the company that insured me, because I make it more likely then that my house will be ripped off, things will be stolen, and I'll file an insurance claim, and they'll have to compensate me for a lost television set or a lost answering machine or stolen clothing. This is the problem of moral hazard, when an insured person then begins to take extra risks, and these extra risks impose a cost on the person who offers insurance. Let's suppose I'm a salesman and I'm working on commission, but I don't like the risk. Some days are good, some days are bad. I'd rather have a nice, safe, reliable income. So I go to my boss and I say, look, I want to get rid of the commission and go on a fixed salary. The fixed salary then protects me from risk and I feel better. And the boss perhaps decides that he's persuaded by my case and he puts me on a fixed salary. Well, what's the temptation then? The temptation is I don't work as hard to make the extra sales because I'm no longer subject to risk. I'm now insured. And being insured, I may be inclined to make decisions that impose a cost on my boss. Not working as hard to sell clothing then, or sell shoes or cars or whatever, then causes my boss and the company to lose revenue. But I'm only doing that because I'm not scared anymore. I'm only doing that because I'm insured against risk. Moral hazard is a difficult problem. It often causes insurance markets to break down. People aren't going to insure you if by insuring you they're going to give you incentive to take risks, which then cause the insurance not to be a profitable business. If we insure people with life insurance and they all decide then they want to go skydiving because they don't have to worry about anyone who may be hurt if they have a skydiving accident, besides themselves, of course, then the life insurance becomes a very difficult product to offer. The price of life insurance goes way, way up because the people you insure then are behaving in a risky way. If you offer health insurance and people decide as a result of that they want to have a diet or other habits that increase the risk that they'll make a health insurance claim, then the price of health insurance has to go up to insure only risk-taking people. Moral hazard can cause a market to break down, and the solutions to moral hazard are to return some of the risk to the person who's insured. That's why insurance companies give you a deductible. If your car is hit, then you have to pay the first $1,000 worth of damages yourself. That way you still face some of the risk. Other things that can happen are when you go to a bank and you take out a loan, they may ask you to post collateral. This gives you an incentive so that if the business that you're starting goes bankrupt, you're still going to lose something. Perhaps your car, perhaps some bonds or something. In any event, with some of the risk restored to you, you're more inclined to invest in safe and profitable business ventures rather than going out and doing something highly speculative or risky. A second thing that happens is that there is co-insurance. That is, an insurance company will only insure you for 50% of your loss or 80% of the loss. That way you still bear a chunk of the risk. You still have to pay 20% of the damages, and that may be enough to incline you to make safe decisions and to protect the insurer from a big loss. Finally, a third thing that can happen that can reduce the problem of moral hazard is monitoring. That is, a company may decide that if you want to have insurance on your house, you have to be subject to an inspection ever so often to make sure that you are locking your doors and windows. Or there may be a provision in your insurance policy that says if your house is ripped off and you left the windows or doors open, then the insurance company doesn't pay as much. This, again, is a kind of monitoring, and the way that the insurance company enforces this is they require you to call the police anytime there's an accident or anytime there's a crime. This makes sure that the police come, investigate, and report that, in fact, yes, the doors were locked. This person was not imposing extra risk through his choices. So, moral hazard, then, arises when one of the agents makes an unobservable choice. You can't tell directly whether I'm leaving my doors open or not. You can't tell directly whether I'm going out and eating fatty foods or smoking cigarettes, but you can, however, you can make it a provision that either I bear part of the risk through a deductible or through coinsurance, or you can incur the extra expense of monitoring my behavior so as to make sure that I'm not imposing extra costs after I'm insured. Moral hazard is different from adverse selection, and we can distinguish the two with a story. It is a part of our modern legend, and it's confirmed by statistics, that people who drive Volvos get more traffic tickets for moving violations than people who drive other cars. Why is it? Why are people in Volvos so often cited for running red lights, running stop signs, and driving too fast? Well, there are two answers that we could give. The first is based on adverse selection. That is, people who know they're bad drivers and are scared that they might get in an accident, they go and they buy a Volvo to protect themselves from the risk of the accident. That way, when somebody shows up at the Volvo dealership, the first question you want to ask them is, are you a bad driver? Is that why you're here? Are you scared of getting in a wreck? There's also another explanation for why Volvos are in so many traffic incidents, and that is moral hazard. Once you own a Volvo, you're not scared of other people anymore because you're driving a tank, and so you can drive fast and run red lights and things like that without any fear. The Volvo protects you from risks and therefore creates a kind of moral hazard. Not being afraid may lead you to take more risks or engage in riskier behavior. So how do we tell whether this particular story is an example of adverse selection or moral hazard? Maybe we inspect people's driving records ahead of time. When people show up to buy a Volvo, if we find out that they already have lots of citations for traffic accidents or traffic violations, then they're coming to get a Volvo because they're already risky. That would be adverse selection. Moral hazard, on the other hand, would be people who drive safely before they get a Volvo, and then once they get a Volvo, they start driving like a maniac because they're protected. In summary, then, asymmetric information causes problems for markets. If people have unobservable characteristics before the deal, then the problem is adverse selection. Low quality drives high quality out of the market. On the other hand, if people make unobservable decisions after the deal, then the problem is moral hazard. The presence of protection from risk, the presence of insurance, leads people to engage in risky behaviors that impose costs on someone else.